So let's dig in. Topic of today, as mentioned, how to launch a token without selling your soul, and more importantly, crushing your community. Want to kick it off with a somewhat controversial truth, sort of a taboo within Web3. Everyone knows this to be true, yet no one speaks it out loud. And that's that token price performance is actually more important than any sort of technology that you build, any sort of fundamentals or utility. It's all about price. When it comes to Web3, price is sort of like the ultimate in user experience. When price goes up and to the right, your community loves you. They rally behind you. They believe that whatever you've built has compelling utility and fundamentals. In contrast, if price goes down only, your community hates you, they'll revolt against you, and regardless of any sort of utility that you've built, the community will perceive your fundamentals as busted. So if you're seeking to optimize for price performance, it really just comes down to supply and demand. And the main components of supply and demand outside of speculation, of course, are three things. The first are your tokenomics designs, so how value is shared and distributed within your ecosystem. The next is your market maker engagements, so how you bootstrap liquidity. And the third and final is your listing and launch strategy. So let's dig in. Forge can help with all of these things. Forge is a free-to-use software platform for projects to design tokenomics, engage market makers, track token unlocks and liquidity, list on exchanges, manage your cap table, and so much more. We're end-to-end. Let's start with tokenomics and dig into some of the tools that we offer as well as some best practices. So tokenomics, what is it? It's really just a fancy word for how value is shared and distributed within a decentralized ecosystem. It starts with the supply. So who's going to receive tokens? What have they done to deserve those tokens? And at what rate are they going to receive them? Historically, you've had to default to messy spreadsheets in order to build these things. Now you can use Forge software for free. We have a dynamic front end where you can build things from scratch, or you can utilize templates from historical projects if you want to emulate best practices. Next, tokenomics is comprised of demand drivers. So these are reasons and rationale as to why people are going to buy and hold your token. They come in two forms, utilities and mechanisms. Using the Forge platform, you can quantify your protocol's unique demand drivers and input them into our models. Where Forge gets really exciting is that it's not just about education, it's more about iteration. We take the inputs on your supply and demand from your tokenomics design. We actually simulate what price performance might look like, because again, it's all about optimizing for price. So if simulated price performance on the forged models is suboptimal, you can take various actions. So for example, you can adjust the supply side of things. You can lengthen the duration of your emissions, have a more conservative rate of inflation. You can also allocate fewer tokens to aggressive selling groups, such as private investors or internal allocations. You can also adjust the valuation, take a more conservative FDV at TGE, or accrue more value back to your token. But again, this is a platform that is more than a how-to guide. We are all about educating and iterating with quantifiable models. Some quick tips and best practices for designing your tokenomics. We recommend anywhere from 15 to 25% unlocked at TGE. That's going to ensure post-launch that you have a relatively conservative rate of inflation. Next, this should be obvious, but for whatever reason, I still have to teach projects this. Governance should not be your only token demand driver. You should be accruing more value back to your token holders, more rationale to buy and hold the asset. Finally, airdrops are really exciting, but customer acquisition cost is very expensive. The expenses are mostly manifest in aggressive sell pressure post-launch, which can crush your community. Move on to market making engagements. Before we dive in, I have to address a misconception within the industry, and that's that liquidity is not provided out of altruism. Oftentimes people believe that liquidity providers are sort of like white knights. They provide this public good which benefits others. And that's just altogether false. At the end of the day, people provide liquidity because they expect to profit. The mechanisms of profit traditionally for large market cap assets, which are widely traded, vary. On a centralized limit order book, you can generate profit from capturing the bid-ask spread. On an AMM, you can generate profit through yield farming. But again, at the end of the day, people only provide liquidity because they expect to profit. When you issue a new token, the market will lack traditional profit opportunities that usually attract traditional market makers and liquidity providers. In the absence of those traditional profit opportunities, you need to bootstrap liquidity as a token issuer. There are two flavors of service providers that you can engage as a token issuer. The first is called a designated market maker. This is a retainer and working capital structure. You pay the market maker a monthly fee. You also loan them stablecoins and tokens. They utilize those assets to provide two-sided liquidity. The second type of service provider is called a principal market maker, more often referred to as a loan plus call option. For this type of engagement, you loan only tokens. You offer the market maker the option but not the obligation to purchase those tokens at some predetermined rate at some date in the future. I like to view the world through the good, the bad, and the ugly. I always want to know what's in it for me and then how I might get screwed. So let's dissect each of these market maker engagements through the good, the bad, and the ugly. Starting with the designated market maker, this retainer structure. The good, they're strategic. The bad, they require stable coins to operate, so they can be pretty expensive. The ugly, it's basically like an asset management engagement, but if they burn through all of your capital, there's no negative repercussions or downside sharing. Moving on to the loan plus call option structure, the good, they don't require stablecoins to operate. You only have to loan tokens and you have no shortage of those. The bad, remember, expected value needs to be positive in order for the market maker to work with you. The only way for a loan plus call option market maker to profit is through self-interested trade activity. The ugly, and this is what we see all too often, if you don't know how to structure the engagement with a loan plus call option market maker, it can turn very parasitic or predatory. So let's dig into that here. This is what I call the ugly principal market maker, the parasitic strategy. And what happens usually for these token launches is that you see a massive, what I call a post-TGE pop. There's a big green candle at the launch, and oftentimes this is a manufactured process by the market maker. They want your asset to achieve an egregious fully diluted valuation. And once it does, the market maker turns around and aggressively short sells the asset, profiting stablecoins as a result. Post-launch, you'll see a calm, then you'll see diminished demand, your emissions shift the supply curve outward, then you might see down-only price action, maybe the market maker actually contributes to that downward price action, and finally they repurchase tokens and cover their spread at a discounted rate. So you have your market makers selling high and buying low, capturing that spread. They never exercise the option to actually repurchase with stable coins. And the off chance that your market maker goes aggressively short and the price actually appreciates, guess what? Your options have given them an inherent hedge. They can cover their short by repurchasing the token at a discounted rate. So tips and key takeaways here. First and foremost, you need to understand that expected value needs to be positive for a market maker. When you try too hard, for example, with a loan plus call option structure to keep their options out of the money, the market maker has no choice but to aggressively short sell your asset. So you really actually want to create a more balanced engagement that gives more upside potential to the market maker so they work as a core extension of your team. Next, you should diversify the type of market maker that you work with. If you have the stablecoin budget, you should consider engaging a designated market maker, retainer, and working capital structure here. So again, put your market maker in a position to profit. And last but not least, you should monitor your market maker. Here's another opportunity that Forge can help with. We integrate directly with your market makers. We consume data related to their trade activity. We consolidate this data to a centralized dashboard so that you can consume key insights and metrics. For example, you can see, does your market maker represent a meaningful percentage of liquidity and fill volume? More importantly, what's the loan utilization ratio? So that's the turnover on the capital. It's really all about maximizing the bang for your buck for these sorts of engagements. Again, remember, EV needs to be positive for your market maker, but it's about creating a balanced structure that benefits both parties. Last but not least, exchange listing. So when it comes to listing your token, we strongly recommend a hybrid approach. List on both centralized and decentralized venues. What this is going to do is maximize efficient price discovery. Fancy way of saying you're going to engage lots of different types of demographics. Retail, institutional, DeFi degens, cypherpunks, the whole gambit. The trade-off associated with listing on centralized exchanges is that historically it's like a black box. Very opaque how this process works, and it can screw over a lot of projects if you don't know how to navigate it effectively. I like to think less is more for centralized exchanges. Oftentimes, I'll get approached by projects about listing on some tier 2 long tail exchange. Really, there are only like 10 centralized exchanges that you should consider listing. This is the list of 10 for this cycle. It will probably change next cycle. When you're viewing exchanges and determining what is the best venue for me to list, view through 3 perspectives. The first, price performance. Past performance is indicative of future returns for crypto exchanges. If an exchange has history of successful listings, retail will perceive your listing as likely to be successful. They will hammer market buy at the open and catalyze up only price action. Next, trading KPIs. Oftentimes, people will look at CoinGecko and CoinMarketCap and use that as the single source of truth as to what the best exchange is. But remember, you don't care about trading KPIs for the majors like Bitcoin, ETH, Solana, AVAX. You care about trading KPIs like volume, spreads, and depth for microcap and mid-cap assets. So you need to be able to analyze that effectively to determine the right listing for your token. Last but not least, accessibility. How much does it cost? What's the due diligence process for this? Lucky for you guys, Forge can help with all of this. We simplify the data on a centralized dashboard so that you can consume insights related to historical price performance, trading KPIs. We give you transparency directly to the fees that you can expect to see from various exchanges, as well as the questionnaires so that you know how to navigate their due diligence process more effectively. Quick tips, like I said, past performance is indicative of future returns. Do not seek to list on a long tail tier 3 exchange because you want to do their team a solid or because you think it's an up and coming exchange. Go with a blue chip exchange. The listings are expensive for a reason, but it is to catalyze retail demand at the open. Next, in the spirit of collaborating with market makers, you need to ensure that there is sufficient liquidity on your opening order book structure to prevent against an egregious green candle at the open, which would imply an aggressive, fully diluted valuation. So that was a lot, and I've been speed talking for the last 10 minutes. If you are overwhelmed, don't worry, we can help. Block out the noise when it comes to launching a token. There's a lot of subject matter experts out there. They like to lecture us. I really think that how-to guides are like all bark and no bite. I think that as long as you, the builder, are equipped with the proper tools and data, you can operate as a subject matter expert, and that's where Forged helps. We are end-to-end, we are free to use, we help with everything from tokenomics to market maker engagements, managing your cap table, exchange listing, and so much more. So feel free to try us out. You can create an account for free, and you can connect with me if you're looking for maybe a little bit more tactical advice for your token launch, or if you're a service provider or market maker and want to talk about getting integrated on the platform. Thank you so much. And I guess we have 2 minutes remaining for Q&A if anyone has any.
There you are.
Thank you. All of this stuff is so overwhelming. It's great to hear from a service provider like yourself. What is your business model?
Great question. So how can we afford to be free? First and foremost, we engage the base layer. So we are free to use for the Avalanche ecosystem due to the efforts of the Avalabs team. Historically, we were exclusive to the Solana ecosystem. We operated in a private beta for the last year. We serviced over 300 projects doing launches in the Solana ecosystem, including a lot of the blue chip names that you've likely heard of.
Any other question? Yeah.
So we're going to be dealing with our own tokens pretty soon as well. And we have New York lawyers, you deal with the SEC, you have all this stuff going on. How does one gather, or a company gather enough information and confidence to just do it yourself with you? Do you provide consultants or advisors from your company helping the individual company that wants to launch? Or it's just you figure out the data, you go ahead and do it, and good luck?
It's a great question. The ultimate goal is to make consultants entirely obsolete, create software AI versions. So if you check out the platform today, maybe start with Forged Academy, and you're going to see over 1,000 pages of in-house authored content. I'm a very big writer myself, so the how-to guides are there. The data, I think, allows you to be more effective than a hand-wavy consultant. I will say, there are established advisory agencies that actually use Forged as a framework. for projects that are looking for a little bit more white glove service. So that could be an option if you do align yourself with an advisor.
Great. And that's it. So thank you very much. We'll have a 5-minute break. Again, I invite you to dance. Nobody dances. Why don't we have